Thank you again, Adam, for joining us today, and thank you for sharing your expertise with us. We are excited to create our perfect portfolio, I'm sure. I love seeing all these faces in the chat. Again, please, if you have any questions on today's subject, please put them in the chat throughout the seminar, and we will have time at the end to answer them. Thank you so much, and take it away, Adam.
Thank you so much to Ace and Jasmine for hosting. Let's take it away.
Hello and welcome. Welcome to Perfect Portfolio Design Part 2. Now this subject is near and dear to my heart, as many of you may recall, because when I was young, my father taught me how to create a perfect portfolio and then ignored his own advice and invested our entire life savings into one sure thing, which sure enough went bankrupt. My family was financially devastated and we never recovered. And the trauma of that event made me determined it would never happen to me or anybody else I cared about or could possibly help, including you, the audience, on today's webinar. We're going to learn from his mistakes and many others like him so that we can take those lessons and make ourselves a perfect portfolio that hopefully can withstand the storms of time. When we started this last month, we showed how creating a good investment portfolio takes you on a journey similar to the road trip that I was about to embark on to go and see my daughter in Vail, Colorado. And the planning is much the same. We went through these 5 steps that we had to know where we were going. We had to map our journey. We had to plan for the unexpected so that we didn't become roadkill on the financial highway as a result of COVID or some other financial catastrophe. And ultimately, we have to build the right vehicle. So that's what we're going to be focusing on today. And remember, we've got to start with the end in mind. The whole point of this is to build the perfect portfolio. And at the end of the day, the perfect portfolio is the one that's right for you. So the tools that we're going to use to build the engine of our portfolio is modern portfolio theory. Harry Markowitz was the father of modern portfolio theory and won the Nobel Prize. And amongst the findings is that asset allocation accounts for 92% of the return of a portfolio, and it has nothing to do with the picking of individual stocks, which before he came up with this theory, everybody thought it was about picking the best stocks to create a portfolio. So what are asset classes? What are these building blocks of a portfolio? Well, these are the main ones listed here. And we're going to look at some of these by examining a particular business. Imagine your daughter comes to you and asks you for $100 to build a lemonade stand because she needs to buy the lumber. Maybe she's got to hire one of the neighbor kids to help her, and she's got to buy the ingredients. And you say to her, sweetheart, I'm not going to just give you $100, but I tell you what, I will invest $100 in your business, and I want to be a 50% owner. Okay, she says, how does that work? It's going to work like this. You can pay yourself a wage when you're selling lemonade, maybe $5 an hour. Then anything you make over that is profit. And I, as a 50% owner, become entitled to 50% of that profit. And you're going to pay me out what's called a dividend. That profit will get paid out to me as a dividend, maybe once every 6 months. So now if you agree to this with your daughter, this makes you a shareholder in your daughter's company. You have equity in her company. You have stock in her company. Indeed, you have ownership in her lemonade stand. And you're going to get a stream of dividend payments. Now, they could rise or fall. There's no guarantee on what you're going to get. It just depends on how much profit she makes. Indeed, you may get no dividends at all if she doesn't make any profit. Indeed, you may never get your principal back. If she gets bored of trying to sell lemonade after a couple of weeks and packs it in, you're out your $100. However, you do get a say in the business. You have voting rights. Now, how much is that stake in your daughter's lemonade stand worth? You paid $100 or you invested $100, but could you sell it for $100 to the neighbor? Well, let's say it turns out it's generating you $10 a year, that $100 investment, you're getting $10 of earnings, what we call earnings of profit. Let's say you want to sell it to your neighbor, and they look at it and they evaluate it like this. They say it has a 10-to-1 price earnings ratio, that if you want to try and sell it to them for $100, so the price is $100 and the earnings are $10. So it's what's called a 10-to-1 PE. Of course, if they're only willing to offer you $50, it means that they think it's only worth a 5-to-1 price earnings ratio. Now, of course, they may get more complicated than this and use what's called a discount cash flow model, where they try to add up all the potential future earnings, because the earnings may be growing or they may vary, but they add them all up into the future. And they also what's called discount them to calculate them in what's called present day dollars, how much those dollars are worth to them today. Now, in order to do that, they use interest rates. And the only reason why I'm bringing this up is because right now interest rates are very low. And in the discount cash flow model, that results in higher equity prices, particularly in technology stocks, where a lot of the earnings are out in the future. So if interest rates go up, prices of technology stocks could fall because their values, according to the discount cash flow model, become less. Whew, that's all very complicated. Maybe ownership is too much hassle. Maybe you should just do something simpler and just lend your daughter the $100. If you do that, you are buying a bond. So let's say you lend her $100 and you say, I need it back in 3 years. Meanwhile, I want 5% interest. So you can get a $5, what we call a $5 coupon, will get paid out to you by your daughter every year. Now, if you're uncertain about whether she's going to be able to pay you back that $100 in 3 years, you could also use her bicycle as collateral, so that if she's not able to pay you back, you're allowed to sell her bicycle to get your $100 back. Maybe a little bit mean, but hey, business is business. So if you now want to go and sell your $100 bond to your neighbor, they might pay you $100. They might pay you more if interest rates have fallen, and if they were to buy another bond from another lemonade stand that only paid them $2.50, they might be willing to pay you more than $100. Maybe they'd be willing to pay you $105, but they'd still only be getting a $5 coupon from your daughter. And therefore, the interest rate, the yield that they're getting from your daughter, would actually be less because they're paying you more than $100. That also means that they're buying your bond for what we call a premium. Now, when it matures in 3 years, of course, they'll only get back what's called the par value, the $100 back from your daughter. So it's going to decline in value over time. So the interest they're getting from it, that coupon, better be worth it. Now, they may only be willing to pay you less than $100 if interest rates have gone up, or if they fear that your daughter may default, if they think your daughter's not going to be able to come through on her payments. One thing I want to point out here is that as interest rates change, if interest rates drop, that pushes the price of existing bonds up, just like your neighbor would be willing to pay you more than $100 if interest rates fell. And that's an important concept to hold on to for later. So these are the points that we just went over. So let's let's have a look at how bonds and stocks and money in the bank has performed over the last 100 years. Here we have it. And this big gray chunk on the bottom is inflation, the eroding effects of inflation. And we see that money in the bank, the green line is what we call 30-day treasury bills, which is very close to having money in the bank. And that's short-term government debt that the public can invest in. And yeah, it's barely kept pace with inflation. Treasuries, long-term treasuries, which are government debt by the US government that it issues to the public, that you can lend money to the United States government for 10 years or 20 years or 30 years or 5 years, those are US treasuries. And those have done slightly better than the short-term debt and better than inflation. Although they definitely struggled in the first half of the last century, coming up to 1970, they did indeed barely keep pace with inflation. However, we can tell that large cap US stocks have done very well, and indeed small cap stocks, the light blue line at the top, have done even better. However, they've had a much rockier road. And indeed, this is what's called a logarithmic graph. If it was done as a linear graph, these drops of the financial crisis would seem much bigger. And indeed, they were very scary for those who experienced them at the time. So you have to be ready for a very bumpy road if you own equities. They're considered more risky. And risk, in terms of modern portfolio theory, is simply defined as volatility. It's not actually the risk of losing your money. It's if something goes up and down a lot, it's considered risky. And indeed, small cap stocks go up and down more than large cap stocks. Modern portfolio theory says that in order to entice investors to take on that volatility, investors must be paid more for volatile investments, for riskier classes of investments. And that there has to be a trade-off. And by and large, that is true, as we saw with the small cap stocks. However, be warned, it is not always true that just because a class of investments is more volatile and therefore riskier, that it will give you a better return. And indeed, that premium that we saw on small cap stocks, that outperformance, has not happened so much in recent years. Now, once you create your portfolio, let's say a client comes to me with $1 million and they want to invest it in a 60-40 portfolio. If they say to me, Adam, what's the market going to do this year or next year or in 3 years? Of course, I have no idea. Nobody has any idea. Indeed, this is the huge dispersion, range of potential returns that could happen in the first year. They could lose a lot of money, they could make a lot of money, and indeed for the next 2 or 3 years. However, one thing that we do know is that over time, the returns start to even out and become much more predictable. So the annual rate of return as we start going out to 10, 20, 30 years will eventually have settled in towards this much narrower and more predictable range. So the longer you stay invested, the less risk there is to your final performance. So you might say, why don't we all have very risky investments that are going to be volatile, but that we know that over the long term outperform like small cap stocks? Well, because is that the right thing for you? Let's look at the retiree that we looked at last month, when we saw how what we call sequence of returns risk can be devastating for a retiree. Sequence of return risk, remember, is even more important than the actual annual rate of return. Sequence of returns risk is when are you getting those returns? So it doesn't matter if over 10 or 20 or 30 years you average, let's say 7% a year. If for a retiree in the first few years of their retirement, as they're taking money out, they have what's called a bear market. If the bear market declines at the beginning of their retirement, it is completely devastating. Looking back at this portfolio, you can just imagine if you just retired and you just started investing and you're taking, let's say, 5% of your portfolio out a year or 10% of your portfolio out a year, and it's going down by 15% a year. By the time you get to 8 years in here, by the time that your portfolio should have come back to normal, you've taken so much out that your portfolio is never going to recover. Indeed, even for a young person, there may be value for having a more balanced portfolio. This is the history of up and down years in the stock market over, again, about the last 100 years. And you may look at this, especially if you're young, and say, oh, well, look, there's many more green up lines than there are red down lines. And yes, that is true. But these red down lines, like in the great financial crisis here, were extremely painful. It looks like one red line there, but this was a long period of declining stock prices and really devastated people's net worth. Indeed, I remember this period that many people have forgotten after 2000, 2001, 2002, 2003. I'm telling you, I was younger then. And to have your portfolio go down, not just day after day, but week after week, month after month, and finally year after year, I just couldn't believe it. It just becomes debilitating, and you finally capitulate and you just stop investing because you don't want to keep investing money and seeing that money go down. Or indeed, if you're a retiree, you are probably very tempted to take your money out of the market. So you need to be prepared for these kinds of situations. And the best way to prepare for them is to have something in your portfolio that goes up when the stock market, the S&P 500, goes down. Well, what is that? We call that inverse correlation if two things move in opposite directions. And the purest inverse correlation that we have to the S&P 500 that I know of is what we call long-term treasuries. And we can see the way that long-term treasuries have acted here. This is the blue area underneath is the return of long-term treasuries over the last 3 years. And the orange line is the S&P 500. We can see how during the COVID crisis, as the S&P 500 plummeted, long-term treasuries jumped upwards. Why? Because investors flee to the safety of long-term US government treasuries during moments of crisis, but also interest rates tend to fall during moments of crisis. And that, as we heard earlier, when interest rates fall, that pushes the prices of existing bonds, including treasuries, upwards. So imagine if you had had both of these during the crisis or over the last 3 years, because that pattern is most extreme here, but that pattern actually happens all the way through this inverse correlation to some extent. So if you'd had both of these in your portfolio, you would have had a much smoother ride as they would have counteracted each other. So let's look at this concept of inverse correlation a bit more closely. Here we have a green umbrella company and we have a red sunscreen company. Well, imagine if you only had the umbrella company, or if you had two umbrella companies, you would be having a real roller coaster ride. Right at the troughs here, you would just want to sell and you wouldn't be able to sleep at night. But by having the sunscreen company combined, you suddenly have a much smoother path upwards. You're able to make inverse correlation work for you. Now, there's a beauty about this, an additional beauty. First of all, this is considered to be a much greater, higher risk-adjusted rate of return than having either one of those investments by themselves. Because remember, risk in modern portfolio theory is considered to be volatility. But another magical thing happens. There's a mathematical quirk where you actually get a higher total return for the same mean average annual return. A less volatile portfolio ends up with a higher total return than a volatile portfolio. Isn't that interesting? Now, additionally, there's a great strategy that we use, or we can use, when you have two inversely correlated assets. Imagine as umbrellas are flying off the shelves because it's so rainy, and it's rainy season, that you decide that you want to rebalance your umbrella stock position because it's becoming overweight in your portfolio and you just want to have 50% umbrella stock. Well, that means that you're going to be selling umbrella stock when it's high, and you're going to be buying your more sunscreen stock when it's low, because nobody's buying sunscreen now and the stock's gone through the floor. Now, of course, this is going to be very difficult for you to do. It requires a lot of discipline because your umbrella stock's doing really well and your sunscreen stock is tanking and you just want to get out of the sunscreen stock. But if you stick to your discipline of making sure that they're both 50%, you're going to be buying sunscreen stock on sale. And then when the sun comes out and we suddenly have a drought and nobody's buying umbrellas, then the sunscreen stock suddenly becomes your champion. But you need to stick to your discipline and once again rebalance. Now, an even more magical thing happens. This purple line starts to go exponentially upwards as you keep selling high and buying low. The beauty of inverse correlation. So does this happen in the real world? Not quite as purely as that, but yes, to some extent between US and international markets. Here is was 10 years from 2000 to 2010 when international markets did much better than US markets. And then the last 10 years, US markets have done much better. Growth and value, what are called growth and value styles, often perform very differently. Growth stocks tend to have very high PE ratios and tend to be things like technology companies. Value stocks tend to be a much better deal. Low PE ratios, you get a lot of earnings for the price. They're things that Warren Buffett likes. Recently, growth has way outperformed value, and it may be time to rotate into the value. There are many different areas that we can do this. There's a lot of what we call expanded asset classes here in the equity sector, and it goes actually way more complex than this. And indeed, there are a lot of different expanded asset classes within bonds where you can do the same thing. We don't have time to go into it today, but I just wanted to show you that. Now, all of these individual asset classes are under what we call the efficient frontier. Now, this was one of Harry Markowitz's other discoveries, that there is a maximum return that you can get for a minimum amount of risk. And that is drawn by what we call the efficient frontier. And that's really where you want to be, because of course you want the most amount of return for the minimum amount of risk. Or put another way, you want the minimum amount of risk for your given return. All of these individual asset classes are underneath the efficient frontier. So any portfolio that simply has one asset class is not an efficient portfolio, let alone if it just has a few individual equities. It's never going to be an efficient portfolio. Look at the S&P 500. Why would you just own the S&P 500 when you can either get more return for exactly the same amount of risk? This is risk along the bottom, and that's return up there. So you can get more return for the same amount of risk by combining it with another asset class. Or you can get the same return with less risk by combining it with another asset class. So choose whatever works for you. You need to use all pieces of the pie and put them together in the way that works best, where they're all working together. Now, we use certain modeling and stress tests in order to make sure that we create portfolios that are on the efficient frontier. And one thing that I want to show you is this little quirk, that a lot of retirees think that by having an all bond portfolio, that they have the safest portfolio they can have, because as we showed before with the lemonade stand on your daughter, you can always sell her bike to get your $100 bond, to get your $100 principal back for your bond, right? There's always that security, and she's obligated to pay you those interest payments. However, an interesting thing is that an old bond portfolio is more volatile, and you'll see that portfolio go up and down more than if you put a little bit of equity into it. Because as we pointed out before, equities tend to be inversely correlated to bonds. So actually, we can reduce the risk of our portfolio by adding some equities to our bond portfolio. And we can both increase our return and reduce our risk. Okay, so we're going to start winding up here, but just some things that I want to point out. When are stocks cheap? People want to know, when should I buy? When are they cheap? One thing to realize, a real kind of rookie mistake, is thinking that the price of a stock relates to its value, that a $3,000 stock is expensive and a $3 stock is cheap. That is not the case. If a $3,000 stock is paying you a big dividend and the $3 stock is paying you nothing, the $3 stock is actually expensive. Also, if a stock splits, let's say you have a $100 stock and it splits into two, many early investors get very excited by this idea. They think that they're somehow getting something for nothing, but you're not. It's simply one loaf of bread getting cut into two loaves of bread. And so how do you value a stock? The way you value a stock is with PE ratios. There are many other ways, but one of the basic ways is price earnings ratio. If you're getting very little earnings and the price is very expensive, then it's an expensive stock. If you are getting a lot of earnings and the price is low, then it is a less expensive stock, generally called a value stock. And the ones with high PE ratios are generally called growth stocks. So can we predict stock market movements and the movements of individual equities? Does a high PE ratio mean that an equity is overpriced and is going to fall? Or indeed that the market is going to fall? Well, strangely enough, that is not necessarily the case. That stocks can go on for many years having a high PE ratio. Amazon has had a high PE ratio for years. We will see what happens with Tesla. And indeed, the stock market itself can have a high PE ratio. It does not mean that it's going to decline in the next year or two. However, there is one thing that potentially forecasts how markets are going to do over the next decade. And that is something called the cyclically adjusted price earnings ratio. This was created by a man called Robert Shiller, another economist who won the Nobel Prize for his work. What is CAPE? What he did is very simple. He said, instead of just looking at 1 year of earnings in calculating price earnings ratios, I want to look at 10 years of earnings. Let's say, particularly for the stock market. What are the last 10 years of earnings? And then I'm going to divide that by the price and see whether that is low or high historically. And what he found is that when CAPE ratios are high, like in 1929, it predicts that the market's going to do very badly or not going to perform as well over the next 10 years. Compared to when you have very low CAPE ratios, like in the 1980s, that's going to predict a good 10 years. And here we have the year 2000, when the CAPE ratio again was very high, and guess what happened? And where are we now? We are heading up to a high CAPE ratio. So just to wrap up, a reminder, modern portfolio theory. Remember, it's not all about picking stocks, it's how the asset classes go together. Unsystematic risk, the risk of individual equities or individual sectors, can and should be eliminated. You shouldn't be exposed to that. The efficient frontier maximizes the return you're going to get for a given amount of risk, so you should make sure that your portfolio sits on the efficient frontier. And just a few tips. A classic saying is it's not timing of the market, it's time in the market. And we saw that with the portfolio where the return becomes more and more predictable over time. If you're saving with your paycheck, remember to what we call dollar cost average in. You're going to end up buying shares for a lower average cost. Make sure it will also help you to buy on sale. Another thing that helps you to buy when stocks are on sale is by rebalancing. It makes you sell high and buy low. For all that, beware of the 10-year CAPE ratio. And when the market gets too ebullient, make sure that you do not extend your risk too far. So we have a process, and you should too. Much like our car journey, we start by determining our starting point. Where are you? And where are you going? Where are your goals? And what's the gap that we need to fill to get there? We then start to build our vehicle with asset allocation. We need to know your risk tolerance, your objective, your investment objectives. And then we need to pick the drivers and get people in the driver's seat to drive our vehicle. Manager selection, we need to deal with cost effectiveness and tax efficiency. And then finally, of course, we're going to be doing the secret sauce of rebalancing and tweaking and with the asset classes to make sure that their portfolios really get that sort of exponential move upwards. So that wraps it up for today. Just a reminder, we've got estate planning essentials coming up, and what insurance do you really need? And again, I don't sell insurance. I'm just going to be educating you about it. So this is us. We're Wellacre Wealth Management. We help you grow and protect your wealth. We would love to give you a second opinion about your financial picture, or just give you whatever tips we can to help you on your way forward. So please reach out to us. Our information is here, info@wellacrewm.com and www.wellacrewealth.com. So my name is Adam Scott, and do we have any questions?
Thank you so much, Adam. I will put that information in the chat as well for his website and email. We do have questions. There have been some great questions that came up. Again, thank you so much for all that knowledge on value. I always get so much and realize how much I am not taking advantage of my investment opportunities. But first question, Adam, is how can we invest in our retirement if they have no active income coming in? They specifically ask, i.e. redirecting funds from a savings account with a low interest yield to something with a higher yield possibly. But main question is, how can he invest into his retirement without having an active income coming in?
Right. So first of all, I want to say that it's that with a question like that, one really needs to kind of to know more about the specific individual and the specific kind of case. I mean, normally I would say make a contribution if you qualify into a Roth 401k, but if you have no income from work, you can't even contribute to a Roth 401k, a Roth IRA. You can't contribute to a Roth IRA if you don't have income, and you can't there are certain income limits too. The other thing, of course, is a traditional IRA, but again, you need income to qualify for that, and you need to talk to your accountant or tax advisor to make sure that you do qualify. But yeah, I would just say, do as you're doing, and to try and get a higher interest rate. If you have a very small portfolio, there are sites where you can kind of start learning how to invest. I would be careful of things like Robinhood. It can provoke maybe I say reckless behavior. Maybe it encourages young investors to be a little too adventurous, I think, Robinhood. So there are other apps out there like Wealthfront. I think Betterment, they do a better job if you want to start getting a basic portfolio going in a simple way.
Thank you so much. I love all your thorough answers. You're always so good at that. I hope that did answer that for you. If not, please feel free to direct message me again, and we're happy to further ask, or please seek out Adam's investment planning. The second question that we have is about bonds. Are bond index funds a good way to buy into that asset, or should they be buying into individual bonds, in your opinion?
Right. Great question. I realize I just do want to do something before we go too much further, which is I want to give a disclaimer that this whole webinar is for educational purposes. It should not be perceived as investment advice. Please do not act on anything from within this webinar without seeking out your own professionals' advice. And any stocks that I've mentioned is neither a recommendation for or against that particular equity. And I will also say that bonds are also fairly inflated. There are many different areas of the bond market, but don't, just because I talk about long-term treasuries, don't jump wholesale into long-term treasuries, at a time like this. It again is just for educational purposes. So now to the specific question about, there are many kinds of different like bond index funds. I say index funds, I guess that's a bit simpler. I would tend to go with a bond mutual fund. Again, without knowing the particular individual, without knowing the size of the portfolio. If you have a significant portfolio, definitely if you're putting $1 million into bonds, you could start looking at individual bonds. I mean, there are people who might have $300,000 that they put into individual bonds, but generally I would say it makes more sense if you've got $1 million to put them into individual bonds. But I would say that for the average investor, that a bond mutual fund as an active, what we call an active bond mutual fund, might be better than just an index fund. And again, that's maybe a bigger conversation for another time. I was almost going to talk about passive investing versus active investing in the webinar, but I felt like there wasn't time. But I think active management can help, ironically, with bond funds, whereas with stock funds, maybe there's more argument for using index funds.
Kind of on that note, my next question is asking, we are likely in a rising interest rate environment, but both bonds and stocks are both inversely correlated to interest rates. So what alternatives do we have?
Right. So the investment world, the professional investment world is obviously dealing with this question, and we are in unusual times. And the higher grade bonds are, the more inversely correlated they are to equities, and the lower grade they are, the more correlated they're likely to be with equities. Now, so lower grade bonds, but things like what are called floating rate bonds, they're lower grade. They are not going to get hit by rising interest rates necessarily, or certainly not as much. So yes, if you were to predict inflation perfectly, and if you were to buy floating rate bonds and you were not overpaying for them, then that could be a great class to have in your portfolio. You wouldn't want it to be the only thing, but that could be good. Traditionally, high yield bonds tend to work better in a rising rate environment. But certainly long-term treasuries, that they're going to sell off. Indeed, they have sold off in the last 6 months or so. They've had one of the biggest sell-offs, as the 10-year treasury went from 0.5% to 1.5%. When you look at the percentage rise on that, I don't mean the 1% rise, but it just increased by over 200%. The biggest move in history, and that means that the prices of long-term treasuries decreased over that time. But floating rate didn't get hit in that way, nor did higher yield. And there are other asset classes that didn't. And finally, what are called TIPS, Treasury Inflation Protected Securities. They can potentially do better definitely in a rising inflation environment.
Thank you. Back to that again, if you don't feel like the question was answered thoroughly, please feel free to message us again. We are here to help today. However, please do seek out Adam's help. He obviously has all the wealth of knowledge. Back on to that portfolio question that we asked from earlier about investing if you didn't have an active income. He wanted to clarify. So he is able to invest into separate portfolios without an active income, but cannot redistribute in the savings into both, into his Roth IRA. Is that correct?
If he does not have, again, so much depends on the individual. There's so many different parts here. If this is a 20-something asking the question as opposed to a 60-something, 60-something with many different portfolios with a lot of wealth versus a 20-something, it potentially there are different answers.
Mhm.
So, but still, the basic, if there's no income from work, whichever of those categories you are, just speaking off the top of my head, right? Shooting from the hip,
We
I would say
appreciate that.
you could not move your money from a non-retirement account, or yeah, from a non-retirement account into a Roth IRA. You can't make a Roth IRA contribution or a traditional IRA contribution or a 401k contribution if you don't have income from work. Now, you could do a conversion. If you're not working and you already have an IRA, you could convert it into a Roth IRA. And that might be a great strategy to do. If you're not working and you're right now in a low income tax bracket, it could be a great opportunity. But that can be quite a complex calculation. So definitely, if you're looking to do like a major Roth conversion, reach out to me and I'll
Seek
look into
out.
it for you. Yeah.
On all counts, please reach out to Adam. Hopefully he'll make us all lots and lots of money. I have another question from Joyce. The gentleman that asked the question said that was much appreciated, your thorough answer though. So I think that you're getting to us. A question from Joyce says that, what's your take on a Bitcoin investment? Since we're shooting from the hip.
All right, shooting from the hip. Well, I have to say, give, so I just want to give some other clarifications before I move on to that question, which I'm sure is on everybody's minds. I realize that in the webinar, I kind of throw out terms like small cap stocks. For those who aren't familiar, small caps means small companies, large cap means large companies. I also use the term S&P 500. I'm sure most of you have heard of that, but it's in the financial industry, the S&P 500, which is the index of the largest 500 American companies, US companies. It's a very standard index. Ironically, the man on the street and the woman on the street uses the term the Dow, and it generally follows the Dow more, but the industry follows S&P 500. Finally, I simply mentioned the word 60-40. A 60-40 portfolio. A 60-40 portfolio, which has traditionally been the bedrock of many investors, is 60% equities, 60% stocks, and 40% bonds. So getting to the Bitcoin question. I recently, a year ago, as many of you may know, I started my own what's called independent RIA. And I'm no longer attached to what's called a broker-dealer like Merrill Lynch, Morgan Stanley, LPL Financial, Raymond James. One of the reasons why I did that is so that I could speak more openly and answer questions such as this, because I could not have talked to you about Bitcoin formally, because if a broker-dealer doesn't sell it, you're not allowed to talk about it. And my clients would reach out to me, and it was difficult for me to talk about it. So having said that, I've been wrong about Bitcoin. I mean, I was right in the sense that, let's say 2 or 3 years ago, I had clients calling off the wall wanting to buy it. And I said that I felt that it could have a massive sell-off, and that massive sell-off came. However, Bitcoin has since recovered. I would say that one major reason why it's recovered for actually 2 major reasons. First and foremost, because interest rates have dropped so much. If you were getting 5% in your bank, you would not be buying Bitcoin, or you'd stop buying Bitcoin if it stopped going up, because you wouldn't be getting any interest on it. So what's called cheap money has propelled Bitcoin upwards. In fact, that's exactly what happened when it sold off last time, is because interest rates rose and Bitcoin sold off. So the other reason that Bitcoin is rising, and this is a much more valid reason, is because of the fear of inflation. With coming out of the pandemic, with all of this stimulus and quantitative easing on steroids, we've had 3 times greater quantitative easing coming out of the pandemic, and 3 times greater stimulus, or maybe 5 times greater stimulus than we had under the Obama era coming out of the great financial recession. All of this is creating concerns around inflation, and Bitcoin is considered to be a hedge against inflation because there's only a limited supply of it. And final disclosure, I finally bought Bitcoin. I meant to buy it years ago and never got around to it. Finally bought it because I thought, you know what? If it keeps going up, I don't want to be too wrong. I'm hedging my bets. And it's gone up quite significantly. But also when I did it, I thought, am I willing to lose this entire investment, right? And I thought about how much money I was willing to lose, and I wasn't willing to lose very much, so I didn't put very much in it. Long-winded answer, but there you go.
Hey, you want it, you get it. Shooting from the hip. I love it. Like you said, everybody was curious, I'm sure. That was all the questions that I have for today. Again, please reach out to Adam. He is more than happy to share his all his wealth of knowledge with us, and we thank him so much for joining us.
Hey, Jasmine, there's just one other thing I'll mention about it. I do wonder with Bitcoin and these, what do they call that? The non-fungible, the NFTs, the non-fungible tokens.
Right.
Yeah, I think many of us in the investment industry wonder if we'll look back and equate it to the tulip, the tulip bubble, as you know, or you may remember from my first webinar, is
seminar.
Yeah, is a favorite thing of mine. And you look back at the tulip craze and you think, how could people possibly have traded their entire estate for one tulip bulb? And seeing an NFT go for whatever it was, $60 million or something. So both Bitcoin and NFTs, I wonder, will people look back on 100 years? But hey, maybe they won't. Maybe at that time the dollar will have gone. They'll all have just been burnt in fireplaces to keep us warm, and we'll just be using Bitcoin.
Hey, we didn't expect this last year either. So, I mean, definitely we could have predicted it. But on that mark, Steven says, isn't Bitcoin a wacko pyramid scheme in which wealth is created without work? What's your opinion on that?
Yes, I mean it's a pyramid scheme.
Strong words, but yes, absolutely.
Well, I mean, because whether it's I say yes, it requires it requires the greater fool, right? It requires someone else to be willing to pay you more for it, because it doesn't provide any wealth. That if you invest in your daughter's lemonade stand, you're actually creating something and you're generating income. Bitcoin doesn't generate income. But there again, gold doesn't generate income. Gold actually does cost some money to hold. I mean, you got to store it in a vault, and you actually have to remelt it every 50 or 60 years or so. Works of art don't, Leonardo da Vinci paintings don't generate wealth in and of themselves. They're just simply a store of value. So as long as people believe that Bitcoin is a store of value, it will be a store of value. And if someone else wants it more than you, just like if someone wants the Da Vinci more than you, it's going to go up in price. But equally, if with Biden's tax plans and with what's going on in the world, if tax rates go up a lot on the very wealthy, and if interest rates go up, blah, 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 if we stop having so much money in the system, even the prices of Da Vinci's will fall. And you may find that the art market equally feels like a Ponzi scheme or a pyramid scheme, for want of a better word.
Wise words from the man himself. I like that opinion. Thanks for sharing. Thank you everybody for joining us today. There will be a copy of today's seminar if you missed any of it on Adam's website. There is a copy of the other seminars that we've had this last year also on his website, as well as the ACE website. Feel free to email either one of us anytime if you have ACE related questions or Wellacre management investment questions. We are both happy to share with you, and we really appreciate you joining us today. Adam, do you have any last words for anybody?
No,
thank you all.
Thanks so much for joining us, and look forward to seeing you next month to talk about estate planning essentials.
Yes, we will have that invitation going out soon. Thank you so much, everybody, for joining us.